Interest rates are dropping across the yield curve and importantly, right at the front end. I mentioned a couple weeks ago that the 4-week treasury bill was seeing its yield go down. Well, it's gone down a lot further since then. In fact, at yesterday's auction, the 4-week treasury bill had a high yield of just 4% flat. And just so you remember, the reverse repo program that the Federal Reserve offers is offering 4.25%. So already we're asking the question, who is out there accepting 4-week treasury bills that are yielding around 4%? There's extraordinary demand for front end bills for some reason. At the same time, we're seeing the yield curve steepen again in the bull condition, which means shorter term rates like those at the 2 and 3-year treasury note maturity, those are down again too, with the 2-year treasury note yield threatening to run into the 360s again like it had been in April. And maybe if it continues to go on, getting you to the lows that we saw back in September. And as the front end and the middle part of the curve is going down, of course, that's dragging the long end down too, because that's the other part of bull steepening. But in the bull steepening case, the long end maybe doesn't go down as far. It lags a little bit. But either way, interest rates are heading lower. And all of the economic data that we're getting across the spectrum tells us why that is. On Friday, we got more on personal income and spending, with a decline in spending and a decline in income. So, Steve, Mr. Van Meter, we've got the curve that's moving down again after, what was it, a couple weeks there where everybody's shouting about, hey, the long end is rejecting the treasury market and afraid of the amount of debt that's being issued. Once again, rates are going to go down in the short run as the economic fundamentals continue to argue for, at the very least, the Federal Reserve to get out of the way, become more dovish, which we've seen there as well. But the economic statistics, they're not looking all that great either.
You're right, Jeff. It wasn't long ago that we saw all this call for interest rates to go higher, that the debt was too big and deficits were surging, and this was going to be a major problem, that the U.S. government needed to pay more. And this brought in a lot of people to dump treasuries, short the market, and yet what did we continue to see? Foreign investors still buying treasuries. And then we saw foreign central banks when we saw the data start to pick up treasuries. And next thing you know, it appears like a bottom is always showing up. And as you said, the front of the curve is starting to lead things lower. This is a big indicator of the economy because we talk over and over on this show about interest rates, particularly on the long end of the curve, are a function of growth and inflation expectations. Now, right now, the Fed keeps telling us that inflation expectations are going to surge higher. We need to keep monetary policy in a restrictive point. But as we know, where growth goes, inflation does follow. So even if inflation were to go higher, what the bond market's responding to is that the trend growth of the economy continues to slow down here.
And you're also saying, implied in what you just said, is that any inflation expectations, quote unquote, price expectations, they're actually going to be transitory, to use that word. And I think it's interesting how the Federal Reserve, and we talked about this last week, how Federal Reserve policymakers themselves are kind of, hey, we haven't seen any consumer price follow through in terms of tariff costs. So maybe we should start to worry more and more about the labor market and conditions and jobs and incomes. So even the Federal Reserve itself, while maybe Chair Powell hasn't come across as dovish as, say, Christopher Waller and Michelle Bowman, who's another one who came out and said, hey, I'm worried about consumer spending, which we'll talk about here. I'm worried about, the labor market breaking. And while Powell at his testimony this week didn't go as far as they had, he did say at the very least, if I don't see a tick up in the CPI, I'm all in favor of cutting rates. So even there's a detectable shift on the Federal Reserve policymaking committee that's moving more toward, maybe we need to start cutting rates because these economic concerns, they're not going away. And if anything, unlike tariff inflation, we're seeing more and more of that weakness in the places we don't want to see it, which is jobs and incomes.
So, you're right, Jeff. I like to compare where we're at right now with the great financial crisis, because if we look back then, we saw the economy was slowing down, but at the same time, inflation was surging higher due to energy prices. And yet the Fed was cutting into rising inflation. But this is the issue we're facing right now. And you mentioned that any inflation would likely be transitory. And that's absolutely what happened back then. Because if we look then, we saw rising energy prices. Consumers had to pay more money, and that took money out of other sides of the economy and then led to an increase in the decline in growth. Of course, inflation then surged higher and then came crashing down. So even if we were to see a pop in inflation right now, I agree, it's going to be completely transitory because, again, it's already taking money out of a consumer's budget and redirecting it. We continue to hear from consumers that are under financial stress. And even though we saw wage gains come up this last month, it's still not enough. And that's the problem. They're still weighted under a slowing economy. I think we got a major issue here that the interest rate market is telling us very clearly the economy is not going in the right direction.
Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. Yeah, we saw that in the personal income and spending figures. First with personal income. They actually declined, which was a surprise to most people, largely due to the fact that Doge had shut down Social Security accounts that were, people who have been long dead, or all the stories that you heard about when Doge was publicizing its efforts. So that actually has had an effect, and it showed up in the statistics. But as Steve, as you just mentioned, wage rates did pick up a little bit with the lack of hours. However, overall pay from wages and salaries, so earned income, they're still slowing down noticeably this year. Plus, you put that together with uncertainty over consumer sentiment, right? That's the term that everybody uses. Spending fell off. It actually fell down for the second time this year, the second decline in outright spending. Remember, personal income and spending includes not just retail sales on goods, it's also spending on services as well, which is another big one. We keep seeing, as the GDP figures reported this week, the revised figures from GDP, that services spending actually led the revisions lower. So what the data coming in shows is that consumers are indeed shifting their behavior, and they're doing exactly what you just said, Steve. They're responding to the rising costs of necessities, or even the smallest rising costs that are pushed through tariffs. They're responding to it by cutting back in their discretionary spending, largely services, but also things like RVs. Winnebago this week came out and said, "Oh boy, we had a bad quarter, and we're not looking at anything good this coming quarter either." So we keep seeing all of these warning signs that consumers they're not negative over trade wars and tariffs. They're negative over what they see as a weak labor market, and potentially the negative impacts from trade wars and tariffs on employers and their margins, which would lead to even more labor market difficulty. So it's not just uncertainty for the sake of uncertainty. It's actually really small economics.
Yeah, absolutely, Jeff. And even though we didn't see hours drop, but we look at the sentiment surveys and we can run comparison with hours worked. And what you get to feel is workers are legitimately concerned that they're either going to lose their job or see the number of hours they get plummet. Now, it hasn't happened yet, but what we are seeing is in their spending habits. And that's a leading indicator, because when consumers cut back their spending, next thing you know, it backflows across the economy. And then next thing you know, you kind of have this self-feeding mechanism where a slowdown leads to panic, and then a further slowdown. And next thing you know, it becomes self-fulfilling. But we talk about inflation being transitory. We can also say the same thing for any increase in yield. Again, it has nothing to do with debt or deficits, as much as people for decades have wanted to make that statement. But that's why we continue to see any move higher in yields gets rejected. It's because the economy is going the wrong direction. The risk now is, again, you're saying we're seeing the front end of the curve start to go down when there's higher yields elsewhere at the Fed. And that's, again, dragging down the mid and slowly the long end of the curve. There's a little fight there at the long end, but you can see it's starting its move lower. And that's something that a lot of people, I don't think, are ready to see. I think consumers want to see lower rates. We'd obviously know the Trump administration wants lower rates, but as you and I know, lower rates isn't what really people want. It means the economy, again, continues to head in the wrong path.
Yeah, it's funny how this always works out, right? We've seen this. I mean, nothing ever goes in a straight line. Like any marketplace, interest rates, they go up and down, they go up and down. You really watch the trend. But any short run period where you see long-term rates rise, we always get filled with these stories across the media how the market is rejecting government debt. There's too many treasuries, all of those theories. Interest rates have nowhere to go but up, and here it finally comes. And while we would like that to be true, we would like the market to reject the government's debt. The sad reality is it's just a short run fluctuation. So when interest rates rise and everybody gets excited, the bond vigilantism has been reborn. Suddenly interest rates go down again and everybody's shocked. Well, where did the bond vigilantes go? Well, they were never there to begin with. So we have to look past these short run fluctuations. And one way that you do that, as Steve was just pointing out, is you look at the entire yield curve. And one part of the yield curve, which was not fluctuating over the last little while here, is that 2 year spot on the curve. It's actually the 2 year and the 3 year. Both of those together are really the target of what is a really substantial bull steepening move. And what they're saying is, forget the stuff at the 10 year. That's just regular steepening that's going on. There's nothing really meaningful about the way the 10 year is behaving here, except that it's part of this steepening process. Everything in the 2 years, as we just said, looking at the economic fundamentals and also looking at how the Federal Reserve might respond to those fundamentals, because as sad as it is, a part of the calculus that goes into a 2 year maturity and the yield that goes there is some of it is independent, long run inflation and growth and inflation expectations impacting the short run. But it's also, you got to pay attention to what Jay Powell and the rest of the FOMC are going to do. And so the 2 year can kind of get hung up on both of those, right? If we see lower growth and inflation expectations, the 2 year wants to go lower. But if Jay Powell's over there saying, no, I'm never going to lower rates, the 2 year's kind of get stuck in between. So we've seen this repeatedly over the last several years of the bond bull market, where the 2 year will go down on fundamentals, and then Powell will say, "Oh, sticky inflation," and then it will kind of hang in there. So we see the 2 year do that repeatedly, and right now it's in what looks to be another emerging leg down in the 2 year, which then feeds into the rest of the yield curve, which is confirmation that the market is saying, growth and inflation, not good. And also, more and more, the Federal Reserve sees the same thing and they're going to get out of the way. So it's the 2 years really sending us an important signal.
Yeah, Jeff, that's a key point here because you're right. The Fed kind of acts as a brake on moves down in yields. But in this case, when you have the yield curve ignore the Fed, which clearly the Fed's been absolutely clear, we are not lowering rates, even though we have a little bit of dissent in the board. It's just not enough to change the bond market. But what this is, again, clearly telling us, growth and inflation expectations are coming down. The Fed can stand back and say, look, we're not going to cut in July or September or who knows when, but the bond market's going to force them to cut rates because we know in the end of the day, the funds rate has a lot of correlation with short-term interest rates. Where they go, the Fed will come up with a reason. And we don't know what it will be, but there will be some excuse if bond yields continue to fall. The Fed will be forced to cut. We'll find out maybe at the next meeting or the meeting after, but that's likely to happen. Now, what equity investors want is they don't want a bull steamer. They want a bear steepener. And this is a problem because the stock market now hitting all-time highs again, telling us that the economy is great. At the same time, Jeff, the bond market telling us the complete opposite is happening. Makes you wonder which one is right.
Well, let's talk about the stocks for a second here, because not all stocks are an all-time high. And I know you know this, Steve, is that, the NASDAQ is leading the way. And that's already a clue there because the NASDAQ has been fed by AI expectations, the AI bubble being rebuilt and reborn. And the S&P 500, that's hitting a new high, but there's a heavy degree of exposure to that area. And the S&P 500 is not all the stocks in the 500 are actually doing well. There's a very narrow part of the index that's actually doing well. And then you get to the Dow Jones Industrial Average, which is more, not quite entirely, but more economically sensitive. And that one is lagging behind. It's had a very good rebound, no question about that, but it's lagging behind. And then you start looking further down the equity curve, for lack of a better term. You get to something like the Russell 2000, and it's still way the hell down here. And you can kind of see in that spread how the equity market still has 1 foot in the camp of, we're not really sure the economy is heading in the right direction. That's the Russell 2000. But on the other foot, we got, AI, that's tech spending, that's going to be relatively robust. So we got 1 foot in AI bubble and another foot in these economic concerns. So maybe even the stock market, the broader stock market, is looking at the same things as the bond market and still thinking, I'm not, stocks are not completely apart from the bull steepening on the yield curve.
No, they're not, Jeff. And I noted, that we saw a lot of people getting short major tech companies at the last correction, and particularly hedge funds. We saw money managers selling, moving to cash, and then retail came in. And I've made comments like this before. I said there's going to be a short squeeze here because if you can drive prices up when other people are short, they're going to be forced to play chase. Because again, in the end of the day, whether you're a hedge fund or any kind of money manager, it's all about your returns relative to the market. You don't deliver, you're going to find a new occupation. And so they got forced to play chase. But you're right. The big red flag here, in fact, there's a couple of them. It's not just small caps. Jeff, how about FedEx? I mean, they are a bellwether for the economy. I mean, you want to know where the market's going? Overlay FedEx against the S&P 500. And there's a big deviation right now. FedEx saying, look, the economy is not getting better. The bond market's saying the economy is not getting better. The small caps are saying, look, all this was going to benefit us, and it appears it's not. The mega caps, hey, everything's great. Well, until it won't be.
Yeah, so I think that leads us into the discussion where we started, which is the very front end of the yield curve and the 4-week Treasury bill. Now, for those who have been paying attention, and I hope everybody's paying attention to the bills because you really should, but for those who haven't been paying attention, the 4-week Treasury bill has been moving lower over the last over a month or thereabouts. Some of it may have to do, at least it was, to the debt ceiling, because we know money market funds, whenever they're faced with the prospect of the infinitesimally small chance that the federal government might delay payments around the debt ceiling limitation, which is set for right around the middle part of August, money market funds will avoid any bill that comes due at that point. So the last little bit here, the last little part of this debt ceiling dance was the 8-week bill. So we saw the 8-week bill yield skyrocket. Well, skyrocket's too strong a term. The 8-week bill yield went up, and it went up noticeably as money market funds avoided that one, which would come due around the middle of August. And at the same time, we saw the 4-week bill yield go down quite a bit, which was likely money market funds and other investors shifting from the 8-week into the 4-week. And so we look at that and say, okay, there's a mechanical relationship there that's easily explained. But we saw the 4-week Treasury bill yield move down before the debt ceiling move in the 8-week. And you and I talked about that before. And now we've seen the 4-week bill yield go down even more, even as the 8-week bill is starting to come back into demand. So it's not simply the debt ceiling that's driving the 4-week bill yield down. And as I mentioned in the introduction, the yield on the 4-week is way below all these alternatives. If you've got cash, for example, if you're a money market fund, why would you buy a 4-week instrument that's yielding, say, 4.1% when you could lend in repo and get 432 or 433? Or at the very least, you can go to the Fed's reverse repo window and get 425. So there's additional demand for 4-week bills over and above what we can explain through the debt ceiling that is driving some degree of, it looks to be, flight to safety at the very front of the yield curve. At the same time, we're seeing the bull steepening happening in the rest of the yield curve. And it starts to become a very compelling case that not about too many treasuries, it's more about these economic fundamentals at the entire length of the curve.
Yeah, Jeff, and that's a key point here because if it was just about positioning for money market funds, then the intermediate and the long of the curve, they wouldn't be selling off. They actually would be, maybe we see yields even rising there, even if they didn't move. But again, we come back to the fact, is the equity market right here or is the bond market right? And when you see the entire curve start to move lower, it tells you the equity market's probably not right.